morning. You're watching The Market right here on 18 Hour with me, Aisha Farid B, Nikunj Dalmia, and still reeling from the shock and the nightmare of yesterday, I guess. There is no other way of talking about what was happening yesterday. What happened at an index level, of course, is another thing. But at an individual portfolio level, Nikunj, the kind of damage and the kind of pain that you're now feeling is something completely different.
Yeah, I mean, it doesn't feel like a bull market now. Yeah. Let me put it this way. And to be frank and honest, nobody saw this coming. This kind of an carnage. Look, there was a case which you could have made, and there was evidence in that, and there was logic in that case that Indian markets were extended and small and mid-cap stocks were due for a correction. But this kind of a reversal, especially in the small and the mid-cap stocks, was completely unexpected and it was not anticipated. If you do a postmortem, it's easy to understand that you're getting crunched. You're getting crunched from everywhere. While DIIs are putting their best foot forward in terms of buying the market, and more the intensity of FII selling has only increased and it's not abating. And then it's a local crowd which is throwing in the towel now. So the desire to trade long, the desire to buy on margin, the appetite to buy the decline really seems to be fading away. And the market nervousness, I think, is clearly evident in the way how stocks are reacting to their numbers. Overreaction to poor set of numbers, exaggerated reaction to bad set of numbers, and a complete breakdown wherever there has been a miss. So good numbers are getting rewarded selectively. Inline numbers are getting ignored, but bad numbers is where the real thrashing in a sense has started. So it's a market, Aisha, where I think you'll have to learn to live with the pain, and I don't see in the near term there is any trigger which really could generate upside. But we are again reaching that point, Aisha, where it may not hurt you if you start nibbling, some stocks back at the current level. You could ask yourself that, okay, what's next? That's the only thing that matters. What's next? How much more you can go? Where is value in this market? And how can you really use this to your advantage? I'm very confident what we're discussing as this ugly fall of January 2025, a year from now, it would be passé. There are so many falls you've seen. They're passé now. How many do we remember? It's just that when you go through that fall, the pain, the portfolio hit, that gives this very growling feeling at the bottom of your pit.
Yeah, I think the bigger question that everyone's asking is that are we headed in for a long pause in the market or in an otherwise pretty much one-way move up of a bull market, and whether last year's highs, all-time highs that is, are going to get retested within this year or not, because so far what earnings are indicating is there is a slowdown, and I don't think we can sugarcoat that.
Yeah, I mean, what do you think?
I think for 2024 the peak is already done. I don't think we're going to revisit that level in 25.
Yeah, I mean, it's so let's put logic to it, right? Can we climb 10% from here? I think it's difficult. And for markets to climb 10% from here, the global setup actually has to change. And the global setup has to be the dollar trades reverses, FI come back, and we see a marked recovery in earnings or the appetite which retail and the trader community have, that actually increases. Based on the evidence right now, I don't see that happening. What may happen is that you will see some migration in sliver of the large cap stocks, which is where the value or which is where the contra approach would do. So that really would be the better strategy. Rather than assuming a return from Nifty 50 in absolute terms, I think you'll have to look at individual stocks where value seems to be emerging, and it's time to navigate the portfolio. See, Aisha, what I feel may happen is that the portfolio positioning has to change. The stars of this rally, they're getting smashed. PB Fintech, Zomato, the stars are really getting smashed in this rally. PSUs have already got smashed. The so-called infra stocks have taken a backseat. Where are railways? Train chhoot gayi sabki. Defense, nobody's talking about it. Those stars are now taking a backseat, and the new stars will start emerging. And that's where I think the market will see migration. And that's where I think you will see, some effect happening. Having said that, if you put data on the table, Aisha, Nifty was up last year 8%. And if one looks at the valuations, and which is where research done a great job, you would ask yourself is that where is the margin of the safety? If you work with an assumption that earnings stays in the range with what everybody is anticipating, markets are not expensive. We are now nearing what could be called a historical average. So Nifty may give you a positive return, but the flavor of stocks which will take Nifty higher may be different.
Okay, lots to wait and watch. But for now, it's been a thumping welcome that the US equity markets have given Trump. And the Dow managed a surge of about almost 500 points. And remember, this after a day's break, tech stocks, they were the ones which were actually surging. Trump is now mulling a 10% tariff on China as soon as Feb 1st. So that's something that, one is keenly looking at for. He's also announced a $500 billion AI infra investment. He's saying that US AI investment backed by Oracle, OpenAI, SoftBank, these are all companies which really jumped up in trade. Of course, closer home, the eye is on the BOJ meet outcome on Friday, wherein there is a rate hike, which is what the markets are penciling in. Asia this morning, China, of course, is taking a knock. It's down about almost 1%. The tariff talk in itself is bringing about that shake off for that index. Hong Kong as well is taking a larger knock right now. It's almost headed in for a 300-point decline. About a 1.5% for downtick is where it's currently at. Good going though for Japan, 600 points up, and the periphery markets as well look quite okay. What about the gift nifty then? That's also indicating a little bit of a reprieve, but again, these are early days. Even yesterday when we came into trade, we were not seeming, or rather looking at this kind of decline that we finally closed the day with. So that really is where seems like the start is going to be. But I think in the very near term, the fact that, we are already at a 7-month low, Nikunj, on the index level itself. Yesterday, blue chips like an ICICI Bank, Reliance, Trent, all these names, they were the top drags. And especially the kind of carnage that you're seeing across the small and mid-cap indexes. I think the bigger question is, how do you navigate this volatility in the near term and the jump up in VIX?
So Aisha, again, that term which we've coined at the beginning of the year, this will be year of high volatility and low return. You have to mentally adjust your portfolio that it's not going to be easy it's not going to be like you start buying the stocks and then you will get a 25% return by the end of the year. It's not going to happen like this. That's part one. Part two, if you are sitting on cash and if you cannot digest volatility, then either you change if you have stocks and if you cannot digest volatility, then raise cash or change the profile of the stocks. The market leadership has changed and we must recognize that. The valuation comfort which was missing from the market seems to be coming back in Nifty, and that's the mathematical number. The basic number, which I would urge our viewers to just stay with us here, 1 year forward is a very simple benchmark in which you look at the number. So what is 18.9? What is this? You look at the Nifty estimates, Bloomberg consensus, that's about 1220, 1218. You divide that with the current Nifty and you arrive at a number of 18.9. If Nifty falls another 5% from here, it becomes 18. If Nifty falls another 17% from here, another 10% from here, it becomes 17. Now, why are these numbers important? Well, you got to compare them with the historical averages, which is that what is the historical average which Nifty has seen. So as per the historical averages, based on 1 year forward, the Nifty valuations are in line or marginally below historic valuations. So the market is no longer expensive. And if markets fall another 5% from here, I think it's time to put money in lump sum in large cap stocks. So that should be a basic Nifty 50 large cap strategy. For mid and small cap stocks, again, there is just like, one shoe does not fit all. You cannot really have one basic strategy. The collateral damage in mid and small cap stocks has been done. Now, if you understand the stock, then don't sell it. But to add more in mid and small cap stock just because of assumption of a V-shaped rally, that may not be there. I expect large cap stocks to outperform first. Within that, it could be a combination of select manufacturing stock, select private banks, few consumption names, and maybe some policy dominated stocks. That's it. Then Aisha, we come to the short term. Where are we headed in the short term? And it's a tricky one to call, Aisha. I'll tell you why it's a tricky one to call. Why? Because A, there is a global mismatch in terms of expectations versus Trump announcements. DIs are selling, are buying, but I think they are running out of cash also. There's limited appetite there. And then there is this real fear which has come back in the HNI and the retail community. So just when we thought that markets were getting ready for a pre-budget rally, I don't see evidence of that. It could change, but to expect some grand V-shaped rally ahead of budget in terms of an hope rally looks
the traditional
difficult.
pre-budget rally, I don't think we're
Yeah.
headed in for one.
Yeah.
For
So
sure.
this, I'm very confident this shall pass, but when you have to deal with it, I mean, you have to face it. That's the only way markets are.